In this video, I will explain how to estimate the expected return on the stock. And for our example, we have Microsoft company, and notice that here we have the formula for the capital asset pricing model. And in order to perform this estimation, we need the risk-free rate and the market return and the company's beta. We already have a video on how to estimate the beta for the company, and it's right here is 1.17 times, and we are missing the risk-free rate and the market return. We will use Damodara's webpage for that in order to get the estimations for historical returns. This is Damodara's webpage from the CERN New York University. Once you are in the web page, just click on data and then click on archive data. The first link you have says historical return on stocks. That is exactly the one we need. And what you see here are the historical returns for Standard & Poor's 500, the 3 months T-bill, 10 years T-bond. So if you browse downwards, you will have the arithmetic average for the period 07 till 2016, and it's actually 8.65% as an average of the returns for the last, I believe that's 10 years. And again, the treasury bonds for 10-year maturities returns are 5.03%, and those are the numbers we have on our estimations up here. So again, we have risk-free, which is 5.03% as an average of the return on the risk-free asset, plus the BD of the company is already estimated, times, open parentheses, the market return minus the risk-free rate. Is estimated right here on the cell B8. I just selected the variables. That's halfway. That is the expected return on the equity with a levered beta. The beta we have here is it's a levered beta. It's a beta that is affected by the company's debt level, the company's leverage. We also need the unlevered beta, which is on cell B18. In order to get that one, we need the tax rate, which is located on the key ratios sheet. You just need to browse and into the profitability ratios. Profitability, we have tax rate as a percentage, and our last 12 trailing months is as an average of 8.4%, and so we type that percent here as a percentage. Then debt to equity ratio, which is the relationship or division between total liabilities or debt divided by our net equity. That estimation is already on the key ratios sheet, so you go into that one, and as you browse, you need to go to liquidity and financial health section, and it's the last one on row 106. This is debt to equity ratio, and we have it on most of the years, and then on our last year is 1.05 times. So we type it here. And last, we have this formula in order to use the lever beta and transform it into an unlevered beta. We only need to apply this formula where lever beta is the one we have up here, 1.17 times for my company, which is Microsoft, divided here by this denominator, and T represent tax rate, which we have here as an 8.4%, times the relationship of the debt over equity, which we also have here as a result. So we only need to perform the estimations, the calculations, as simple as this. So it's notice that parentheses are important here, so please do respect that. And last, in order to estimate the valuation for the company in this sheet, I suggest you find what the AAA or best quality bonds of your company is actually paying as a yearly return. I found out that Microsoft is paying at 2% on AAA bonds. Um, to find that for your company, you might want to go to Morningstar. Just wait a second till it loads. Now here I have, as an example, I have Walmart stores, and the last of the menu, the last option in the menu, as you see here, is bonds. So I click on bond. Then we have all the bonds issue information, and as you see here, you find many of the bonds that Walmart has issued, and there is one here for $3 billion, $3,000 million. As today, the coupon is 6.5%. So you might want to use that as a way to approach to the question, what is Walmart right now paying on debt. So it would be a good approach to use what they're paying on their most important bonds. These are the ones with the higher amounts issued. So you just paste this. And last, here we have the long-term growth rate, which is actually very subjective to your opinion, but it is also a good idea to consider the growth opportunities of the industries. For example, if your company is into the biotechnologies industry, which is expected to grow at a higher rate, is actually young. Let's say it's a young industry with growth opportunities in the future. For a big company, it would be reasonable to think it would grow at a bit higher than 3%. It's possible. But if your company is into a very mature, long time existing industry, like for example soft drinks, Coca-Cola, Pepsi, all those types of companies are in the soft drinks industry, it would be more than optimistic to think it will grow at a 2 or 3%, maybe a 1% it will be more reasonable for those type of old mature business that has gone into most of the possible markets there is. But for, let's say, electronic consumers, there are many new markets to approach for many of the big companies, so there are more growth opportunities. So you might use some subjective opinion on it, but it should base on some of the expectations we see in the reality.